In finance terms, consolidation refers to the incorporation of the financial statements of all subsidiaries into the financial statements of the parent company. Consolidation of financial statements requires the parent company to integrate and combine all its financials to create a standard form income statement, balance sheet, and cash flow statement as part of a set of consolidated financial statements. In this video, we will talk about the balance sheet consolidation. To create a consolidated balance sheet, we would take the balance sheet values of the investor and the investee and add them together, and then apply transaction effects. Transaction effects in this case scenario would be the shareholders of the investee have been bought out, so we need to zero out the investee's shareholders' equity on consolidation. Secondly, the transaction must be financed, so we need to summarize in the sources and uses of funds table. And then, last but not least, we need to calculate the premium paid above book amount and allocate component parts, step ups, step downs, and goodwill. Let's take a look at goodwill calculation here as well, as it's an important part and you need to understand how to assign a goodwill for the consolidated balance sheet. So consolidated goodwill would be a sum of investor goodwill and investee goodwill, and also plus minus investee goodwill as we zero it out, plus the deal goodwill. When we're calculating the deal goodwill, we need to take equity purchase price of the investee and subtract shareholders' equity bought at fair value. And here it has to be only a proportion that has been purchased in terms of percentage. Now, to calculate shareholder equity at fair value, we will take investee shareholder equity at book value, add asset step ups and liability step downs, and subtract asset step downs and liability step ups. And we always will step down investee's goodwill to 0. So let's take a look at the example of balance sheet consolidation in Excel in the following video.